For almost 30 years, the global economy has been living inside a financial hallucination. Cheap mortgages didn't happen by accident. Record-breaking stock markets weren't organic. Governments borrowing trillions without consequences wasn't discipline or economic genius. It was a subsidy, and it came from one place most people were never told to watch: Japan. For decades, Japan quietly held up the global financial ceiling by printing endless yen, buying debt no one else wanted, and keeping interest rates artificially low for the rest of the world. That invisible support made the modern financial system feel stable, predictable, even normal. But earlier last month, that silent support stopped. Japan didn't just tweak a policy or adjust a dial. They triggered what may become the largest margin call in financial history. They call it the Unwind. I call it the end of the free money era. And today, I want to show you the lie that kept your cost of living artificially low, and the one signal that proves the global debt crisis has already reached your front door. Because despite what most people believe, interest rates are not set by central bankers in suits meeting in Washington or London. That's the comforting story. The reality is much quieter and far more dangerous. For nearly 3 decades, global liquidity was dictated by a massive, invisible subsidy flowing out of Japan. It acted like a rising tide that lifted every asset class while hiding the sharp rocks of sovereign debt beneath the surface. Japan became the buyer of last resort, the invisible bid that kept the system alive long after the math said it should have collapsed. They printed yen to buy US debt, European debt, corporate debt, and anything else that needed a buyer when confidence ran thin. By doing that, they suppressed interest rates everywhere else. Governments could borrow freely. Markets could levitate. Housing prices could detach from wages without immediately breaking the system. It felt stable, but it wasn't real. The entire structure depended on one assumption: that Japan would never wake up. The mechanism that made this possible was known as the carry trade. But for most of its life, it behaved less like a strategy and more like an economic law. Money in Japan was almost free. Borrowing costs hovered near zero for decades. Global investors borrowed yen, converted it into dollars, and parked that capital in higher-yielding assets abroad. U.S. treasuries, American stocks, real estate. The trade worked not because it was clever, but because it was protected. As long as Japan kept rates pinned down, the risk never surfaced. Losses were theoretical. Gains felt guaranteed. Over time, this trade stopped being optional. It became structural. Pension funds relied on it. Banks built balance sheets around it. Governments benefited from it without ever acknowledging its source. The result was a world where price signals stopped working. Interest rates no longer reflected risk. Debt no longer reflected scarcity. The cost of money lost its meaning. When borrowing is cheap forever, discipline disappears. Politicians learned that deficits don't matter. Investors learned that downside is temporary. Households learned that leverage is normal. Every incentive in the system points toward more debt. And as long as Japan stayed asleep, there was no penalty for believing that illusion. But physics eventually applies to finance. On November 12th, a single number flashed on bond traders' screens in Tokyo: 1.7%. To most people, that sounds harmless. In global finance, where trillions of dollars are leveraged on the assumption of zero, it's a gunshot. It marked the highest yield on Japan's 10-year government bond since 2008 and, more importantly, signaled that the Bank of Japan had lost control. For years, they promised to buy unlimited bonds to keep yields low through a policy called yield curve control. It worked until the market decided it didn't. When yields broke through the ceiling, it wasn't just a policy failure. It was a loss of credibility. As yields pushed higher, the math behind the carry trade collapsed. The gap between borrowing costs in Japan and returns elsewhere began to close. Suddenly, the free money wasn't free anymore. Positions that had been safe for decades became dangerous overnight. Funds that relied on stable correlations were forced to unwind. This is how margin calls spread. Not through panic headlines, but through quiet liquidation. One position forces another. Liquidity vanishes exactly when it's needed most. What looked like stability reveals itself as leverage stacked on leverage. This shock didn't stay inside Japan. When the anchor of global interest rates cracks, every bond market feels it. Risk gets repriced everywhere at once. Sovereign debt stops being sacred. And for Japan itself, the consequences are brutal. Japan's government debt now sits at roughly 263% of GDP, the heaviest burden in the developed world. For years, zero interest rates made that survivable. At higher yields, the math turns violent. Every increase adds tens of billions of dollars to annual interest costs, money that can't go to healthcare, infrastructure, or defense. It disappears into debt service and compounds every year as old debt rolls over. To cover those costs, the government must borrow more. More borrowing increases the debt pile. A larger debt pile scares investors. Investors demand higher yields. Higher yields increase interest costs again. This is a debt spiral, and once it starts, it feeds on itself. In corporate finance, this stage has a name. It's when borrowing exists only to service previous borrowing. Japan has been able to delay this reality longer than anyone, but delay is not avoidance. Faced with this pressure, Japan turned to the only tool it has relied on for decades: spending. A massive stimulus package was announced, framed as support for households and growth. In another era, markets would have celebrated it. This time, they didn't. Investors didn't see relief. They saw more debt issuance from a government already drowning in obligations. The announcement didn't stabilize the bond market. It accelerated the sell-off. The invisible buyer that once absorbed everything is gone, and the Bank of Japan can no longer carry the entire market on its own balance sheet. Japan is trying to fix a sinking ship by drilling more holes in the hull. The tragedy is that the Japanese economy genuinely needs help. Demographics are collapsing. Growth is weak. Living costs are rising. But decades of financial distortion have removed every safe option. And the shockwaves don't stop in Tokyo. For months, people in the United States have been confused. The Federal Reserve started cutting rates, promising relief, yet mortgage rates stayed high or moved higher. Borrowing got more expensive. How does that happen? The answer is Japan. For decades, Japan was the silent buyer at U.S. Treasury auctions, soaking up American debt and suppressing yields. Now that buyer is gone. Japanese institutions aren't just stopping purchases, they're selling, bringing capital home to stabilize their own system. This is the unwind. At the exact moment the U.S. is issuing record amounts of debt, its largest foreign creditor is walking away. Fewer buyers mean higher yields. That's why your mortgage is more expensive. The era where America could export its inflation to the rest of the world is ending. There's a cruel irony in all of this. For decades, Japan fought deflation, printed endlessly, begged for inflation, and weakened its currency on purpose. Now it finally has inflation, but in the worst possible form. This isn't healthy growth. It's cost-push inflation driven by a collapsing currency. Energy, food, and imports get more expensive. Wages fall behind. Living standards drop. The central bank is trapped. Raise rates and bankrupt the government, or keep rates low and destroy the currency. Monetary policy becomes powerless. Japan isn't unique. It's early. This brings us to retirement savings. For 40 years, the financial world relied on one assumption: government bonds are safe. The 60-40 portfolio worked because bonds were supposed to protect you when stocks fell. That assumption is now broken. When the biggest buyer becomes a seller, bond prices fall as yields rise. At the same time, stocks fall because borrowing costs rise. For the first time in a generation, stocks and bonds fall together. The asset that was supposed to protect you becomes a source of risk. Conservative pensions are trapped in instruments that lose value in real terms. What was sold as risk-free has become return-free risk. While the public is told to stay calm, central banks are quietly doing something very different. They mocked gold for decades, yet now they are buying it at the fastest pace since World War II. Not because of ideology, but because sovereign debt now carries counterparty risk. Gold doesn't. It isn't a promise. It isn't someone else's liability. It doesn't depend on a government staying solvent or a currency retaining value. It simply exists. Across the world, countries are moving reserves out of paper and into hard assets. This isn't politics. It's survival. History shows that when fiat systems reach their mathematical limits, wealth doesn't disappear. It moves. From paper to substance. From unaware to prepared. The silent giant in Tokyo has moved, and its movement is shaking every pension fund, every mortgage, and every portfolio in the Western world. I'm not a financial advisor, and I can't tell you what to do. But I can tell you what I see. I see smoke under the door, and I see the people who built the system quietly leaving while telling everyone else to stay seated. The Japan unwind is the smoke. The 1.7% yield is the alarm. Most people will ignore it until they feel the heat. But you're watching this, which means you're not most people. You've seen the mechanism. You understand the math. The era of the fake economy is over, and the era of real consequences has begun. The only question left is whether central banks can stop what's coming, or whether mathematics has finally won. Let the record show where you stood before the history books are written.